Let's bring in Deborah Weinswig. She's founder and CEO of Coresight Research and a former top-rated retail analyst at Citi. Deborah, great to see you again. A lot of people following the stock were a little concerned about where Target is heading, but they seem to have put some of those worst fears behind them.
Yeah, so they had an analyst meeting today and talked about their guidance for the year ahead in terms of traffic, looking at comps and also margins, and provided some details, but I think that there are a lot of questions that many have around the strength of the consumer, but also a lot around kind of macro policy, et cetera, which certainly could impact that.
All right. So in an uncertain, it kind of goes back to what we were just talking about with Goldman. If you think the market's going to do great, you want to own them, and if not, you don't. I mean, is it that binary for a company like Target?
Absolutely not. So I think that if you look at top line growth, the story of 22, a lot of it was around inflation and traffic. They're still talking about having great traffic. Inflation is abating. I mean, in the past 4 months, most of their key categories are down well over 200 basis points. So top line could definitely be muted. But as we start to look in the margins as well, on the gross margin side, there have been, and they've been probably the most public company around challenges with shrink. So that's merchandise leaving without being paid for. And then many retailers right now are also facing pressure as it relates to SG&A around higher labor costs. However, on the positive side, and they did talk about this, but I would say, the details were scant. And this could be the kind of, where it all does follow the bottom line in a very interesting way, is this idea around retail media networks. And so that is right where you're working with vendors and you have this opportunity to monetize your digital shelf, not just the physical shelf.
Two questions quickly back to back. One is, how much are they going to have to discount to start moving general merchandise, number one, and how's that going to affect their business? And number two is the question about, well, why don't you just take question number one first?
That's actually a very important question, because they were very transparent about how bloated their inventories became in 22, especially around holiday. So I believe they said in the call, discretionary inventories are down about 13%. And so they have worked through the majority of that. There certainly could be product that's backed up that's not on their balance sheet at this point. So I do think there have been these inventory issues, and they are very focused, right? I mean, their customer obviously is coming in, multiple times a week, I would say about 2. So they're getting a very good read, and they seem to have adjusted their balance between kind of, if you will, fashion and, discretionary and staples. But even within categories like apparel, footwear, accessories, they are definitely a bit more kind of weighted towards basic merchandise right now, with a fashionable flair, as it is Target. But certainly I think they are being prudent in 23. And I think that, that probably is right now, from an investor perspective, one that people are probably more comfortable with.